taking some copious notes today because we're going to be talking about quite a few things, okay? We want to say welcome, number one, to everyone that had the opportunity to come in today, to be with us, to start talking about what you can do to change your finances and how to make sure that you're making the best possible decisions for your household. One of the things that we get a lot of is people asking, what about my 401k? What's going on right now? How can I find a better way of savings? Savings is one of those things that a lot of people are just so uncertain about. So we're going to talk about that today. I'm going to show you some Google things that you can look for and how to find better savings for your household. And then we're going to talk about one of the main things that's going to set the foundation for what we're going to cover for the rest of these several weeks. And that's going to be your mindset and money. Mindset and money. That thinking mentality, it changes so much about how you operate your money and your cash flows, right? And your cash flows. And if you can't get the mind right first before you start attacking anything else, then everything else just falls by the wayside. It's sort of like a domino effect, okay? Like a domino effect. So let's start looking at a few things. And before we do that, I'm going to chime in a little bit and give you a little bit of my background and share just a little bit for those people that are new to me. I do see there are some new people here that have not had the opportunity to work with me before in the past. So for those that have not, we want to make sure we brief that as well, okay? So let me do this real quick. I want to show you something. And 1 second. And we are going to look at a few things here. And I want to share some information with you on my background, okay? And quite a few of you already have seen my background before. I've actually worked in the banking industry for many, many, many years, about 20 years or so. And one of the things that I used to do is help people with their credit and finding the proper structure for their savings and things that they need to put their money in, what's the best possible way to protect their risk and against loss. So I want to make sure that we get a good idea of all the things that we've actually worked for in the past, how we can use that now to implement the future. In this quarantine that we're currently in, and then also with the economic pandemic that we're going through, there are quite a few things that are changing, things that we've never seen before, things that we've never had the opportunity to, change in the future because we've never had it before. So what you're looking at is a historical event that's happening right now. So I want to show you just a brief information about my past. I have been in banking for over 20 years, working in the credits, working in the financial structure, and in addition to that, helping with protecting your money against risk and loss. And so that's going to be the main thing that we're going to be talking about in these Wealth Wednesdays, the second and fourth Wednesday of every single month for 2020, okay? So that's going to be really important that we stay focused and also to help you with what you need to get help on. At the end of everything that we talk about today, I'm going to ask you guys to give me some questions. We're going to do some Q&A, and we're going to also allow you to ask a few questions that you would like to ask. Maybe if you want to do a separate session, we can definitely do that, but this will give us an opportunity to get started, okay? So let's dive right in on a few things, and I know that, this is one of those things where you just like, oh goodness, I don't know about all this insurance stuff and this saving stuff, but it is part of everyday life. And we have to get through it. We have to get through it. So I want to ask you guys, where are we? Where are we at this beginning? Right now, there are so many things that's going on in our economy. And one of the things that has really hurt us is the ability to be able to save and not live paycheck to paycheck. At this time, more than 74% of all employees are living paycheck to paycheck, according to the American Payroll Association. Now, that is just outrageous. It really is, because unless you're able to have just a little bit of discretionary to put to the side to help yourself, then it makes it harder and harder for you to one day say, hey, I want to be able to do this for my family. I want to be able to, do this for my retirement. There are some things that I really would love to do in the future. How do I get there if I can't put any money to the side because of paycheck to paycheck? And it's not anything that, has really hurt a lot of us at one point, but what it can do is it can knock down the amount of things that you can do in the future if you don't attack those things now, right? So I wanted to make sure you guys were aware that it's actually out there. You're not the only one that are trying to change things in their finances and trying to change things as far as savings and being able to move on to the next level, okay? Now, what has happened is that in the last 9 to 10 years, financial literacy has taken a quick dive, okay? And that's part of the reason why savings have become at an all-time low, and that we just need to start changing a few things, usually about our relationship with money, how we address money, and then how in the world do we use it later on, okay? So I want to look at something else for you. And this is going to be a little bit interesting. So when you see this, you're going to say, oh God, how in the world do I pull this together? Well, let's look at this real quick. I want you to see one thing that most people don't know about. And they're not going to really show you this on most conferences, or they're not going to tell you much about it when you go to different segments. They're going to say, no, that's not true, that this is simply not the case. How do we even show that it is the case? Well, I want you to understand that in the banking industry makes money off of your interest, okay? They make money off of your interest. And if you're not able to pull things to the side and make more educational decisions for yourself, then what they do is they take that opportunity to be able to charge you more interest on a loan, or, maybe your credit is not as strong, so they can hit you with something a little bit higher in rates and things of that nature. But you have the ability to combat that. And I want to show you a few things. Look at here. This is one of these little rates here. It's going to talk about how the American grasp of financial literacy is slipping, okay? And they're talking about from 2009 to 2018 and how it has really divided the nation on income, okay? So where do you begin on your income? Now, it's not enough to make great income. You have to learn how to save the income that you have, how to knock out the amount of money that you're losing, okay? How to knock out the amount of money that you're losing. Because if you don't do that, right, you're going to find yourself in a position where you can't get everything where you need to go, okay? I want you to look at something else here, and I thought it was tremendously cool. Let me pull this over. I want to pull this over right quick, okay? We're going to Google something that I thought was tremendously amazing for you guys to see. We're looking at high interest yield savings accounts. Can you guys see this screen? All right, so let's see here. Are you able to see the Google screen? No? All right, so let's go ahead and make sure it shares properly. One moment. We are going to share this screen here. There you go. Can you see that screen now? All right, so the high interest yield savings, right? What it is showing here is the top 10 best savings accounts 2020, right? For those people that are actually calling in, you won't be able to see this. So later on, when you get the opportunity, I want you to go ahead and Google the top high interest yield savings accounts. And if you can put 2020 behind that to narrow it down, okay? Now, currently, if you are going to your brick and mortar building bank, They're not going to show you what else is out there that you can be getting interest on. Does that make sense? So let's just say that you go to a regular bank, they may pay 0.03% or 0.5% or something of that nature, right? But if you actually go out there and look a little bit deeper, dig a little bit deeper about what you can do with your savings, you can find other savings accounts that will pay you higher. These are banks that you actually already know. You have seen them before. You've seen their commercials. American Express, Discover, hello. You've seen all these companies before, right? And not only have you seen them before, you probably got a credit card with them, right? Yeah? Do you have a credit card with them? I see Miss Charmaine shaking her head. Yes, yes. So you have credit cards with these exact same companies. And the thing is, they're able to pay you higher on your savings account versus a brick and mortar building. Why? Because they don't have the fixed costs of paying for employees that have to go into a building. They're paying lease on a building that they're leasing and all these other things that they're paying fixed cost on. Don't have that cost, okay? So what they do is they put that money over to you more into savings, right? Okay, here are just a few others. And mind you, just as a disclaimer, I'm not tied to any of these companies. I just want to show you how you yourself can use those fingers and use that smartphone to look for something that's going to help you more on your savings account. Okay, now, what does this mean to you? Compound interest is a powerful thing. Compound interest is a powerful thing. So if you're looking at Goldman Sachs at 1.3%, this is compound interest paid on an annual basis. You'll see it on a month-to-month disclaimer. You'll see it on your percentage rates. And then you'll also get that information at the end of the year when they send you an end-of-year statement of how much interest they paid you for the year. Of course, you'll get those statements every year. But if you are currently putting your money right now into a savings account, why not make the bank pay you to hold your money? It doesn't make sense, really, to give them your money, hold it into an account. What they do is overnight, they use what they call sweep accounts. And sweep accounts is when the bank is able to use the money that you've put into your account as sort of an asset, as a depository, as a collateral for them to be able to do their investment overnight with your deposits. Now, your deposits is sitting inside of your account. But because you are on deposit and they have it on file that you have 5,000, 10,000, 20,000, 60,000, whatever it is that they have inside that account, they have it listed there, which means they can use it as collateral to invest for their own banking institution overnight. And that's what they call sweep accounts. Now, what percentage of that investment are you receiving back? 0%. 0.01% to be exact. To be exact, 0.01 or 0.3. I've even seen, oh goodness, about 4%, right? So you can get a 4% return. You're doing really, really good. And I actually ran across a 4% checking account the other day. I'll share with you guys later. Y'all can use that. That's a freebie. But just think about it. If you're not getting anything on your returns, why should that banking institution hold your money? That's a question that you have to ask yourself as a person that is getting a relationship with your own money, right? Right? Does that make sense to you? So I wanted to bring that up because that's one of the things that we all tend to forget is, hey, I'm letting you hold my money. I'm letting you hold my money. How are you going to help me? Help me help you. Right? That's my mentality, to help me help you. Does that make sense? So while we're out here on Google, let's also look at a calculator. Ooh, goodness gracious. This is my favorite part right here. Compound interest calculator. All right. Compound interest calculator. How many of you guys use this? I don't see nobody raising their hands and they move, they're using it. Why aren't y'all using this calculator right here to figure out how much money they're going to give you on your money? Okay. So they see they already got this pre-filled, and they're using the average, rate of return right here, that 0.25%. And let's just say, and I'm going to use, let's just say we got 5,000 to make as a direct deposit. Maybe you got some money sitting somewhere and you want to put it somewhere, right? And you say for the next 10 years, I'm going to save and I'm going to contribute maybe about $50 a month. Okay, let's just be conservative, $50 a month. And 0.25% is what they're currently paying on there, compound annually. So let's calculate that. That's at, how much is that? 11,203 is what they're expecting that you will have in that particular account after 10 years, right? 11,203 at 10 years. Now, we just looked at some other ones, right? For 1.3 and 1.4, and y'all remember those other compound interests that we just looked at, the other interest rates that we just looked at? In comparison to this, and we're not going to change nothing but the rate itself. Let's go ahead and just change the rate itself. 1.3. Let's calculate that. So at the 1.3, you're looking at the 12,098. You're still keeping everything exactly the same, right? You paying the $50, 10 years, $5,000, initial deposit. 1.3% is the rate of return, right? And instead of, that's a good $800-900 difference on it just sitting there. Now, just reminding you now, it's just sitting there. It's not like you're doing extravagant. You're just paying the same $50 that you were paying. You put in the initial $5,000. So if person A did the exact same thing that you did, and person B decided to go to a different route, why is it that person B getting paid more than me? It's all about the choices. It's the choices that you made to be able to put that money into a savings account, put however amount of money you want to put in there, and then how much you're expecting to get in return. Now, I had this particular question posed to me the other day. They wanted to know, well, Dee, I want to also put my funds into a Black-owned bank, and I want to make sure that I'm getting good return. What do I do? All you do is just alter your search on Google. If you want to look for a high interest rate return bank, Black-owned, or whatever your criteria is, that's what you put into your search, and it'll give you a listing of those things with that search. Now, that's not the end of it. You're still going to have to do the work, okay? You're still going to have to do the work. That means you're going to have to go through that list of the banks and credit unions that they give you to find a bank or institution that meets your interest rate criteria. But do not, by any means, just deposit money into a bank, just to deposit money to the bank without knowing what it's going to do to benefit you. Does that make sense? Before we go any further, because this can get, the next subject can get kind of in-depth, I want to give everybody an opportunity, if they have a question there, to go ahead and ask a question. Is there anybody have a question for me at this time?
I have a question. This is
okay.
If you change the amount, say you do $150 every month versus $50, does that change the amount as far as the interest and all that good stuff?
Yes, it will. Yes, it will. Because what it's going to do is it's going to actually calculate according to what the balance is at the end of that month.
Okay.
So let's just say that you're doing 150. Let's use your example. If you're doing 150, look at that calculation there.
Okay.
You see that?
Mm-hmm.
See, so what has happened is that compound interest is a beautiful thing. What it does is the banking institutions use a 30-day cycle, usually between 26 to 31 days. And in that 26 to 31 day cycle, they look to see what your average balance is at that time, right? The interest rate is calculated according to what your average balance is from point A to point B. So let's say if you have $5,200 in there from January 1st to January 31st, just for an example. When February the 1st comes and they start looking at your rate of return again for the next month, they're going according to what your ending balance is at the end of that January time frame. Okay. So that's why you're getting the compound interest as accumulating higher, because you're making a monthly contribution right here.
Gotcha. Okay.
Yeah. Great question. Great question. Anyone else have a question? All right. That was a really good question. Thanks for sharing that. And we're going to go to the next area here that I want to show you. And the reason why I wanted to start here, when we start talking about Wealth Wednesdays, I wanted to start right here, because if we don't start talking about the relationship, the small parts of putting your money away to the right places, by the time we get to the point where we're talking about fixed assets and rates of returns and 401k rollovers and all this other stuff that's to come in the weeks to come, then the foundation haven't been set yet, okay? So what we're trying to do at this point is we want to make sure that we get everybody on the same playing field, bring everybody up at the same exact area, because we're meeting you where you are. So no matter where you are in your financial situation, we want to make sure we meet you where you are, okay? So with doing that, we're starting here on the basics of how to create your own savings and how to do it in the right way, and exactly how to choose the right savings for yourself, okay? And if we can do that, when we start to build, we'll be able to go even further. So I want to show you that. I want to go here. What is the relationship that you currently have with your money? Ooh, my goodness. What's the relationship that you currently have with your money? And I have to ask everybody this question because it's so important, and it gives me an idea of who's all here with us today, right? I'm going to unmute. Tell me, guys, what is the first word that comes to your mind when you think about money? What's the first word that comes to your mind?
Abundance.
Abundance. That's a good one.
I like that one, Charmaine.
Abundance.
What's another good word that comes to your mind?
Can I see me?
Before mine would be spend, but today is save.
Really? Yeah. Before it used to be spend, and today it's save.
Yes.
Okay. And you know what, guys? I forgot to tell you this in the beginning, so charge my head, not my brain. I was thinking about everything else. But we are recording this for training purposes, okay? So if you had some more questions or you wanted to go back and re-listen to a few things, you'll be able to go back and listen to this later, okay? So just want to make sure you're aware of that. But yes, abundance, that's a really great one. You said spending, now save. Ooh, I want to ask her so bad, what made you change your mind?
Oh, I'm very transparent. I can share if you want me to.
Sure, go ahead, share.
Bankruptcy.
Oh, I gotcha. Okay. That is enough to make you change your mind.
Yeah. Right. I'm not going back there anymore. I done did my time, and it's over with.
I gotcha. And that's one of the things that's really important that we talk about that too, is because when you start thinking about who's around you, and possibly maybe the people that you grew up with, like your parents or your siblings, and the relationship that they have with money, and how they spend money and things of that nature, it also takes a part into what we think we're supposed to be doing with our money as well, right? So that is very important, and I'm glad that you shared that. Thank you for sharing that. Do you trust yourself with money? Is another thing. You know, when you have these relationships, and I talk to my girlfriends about this all the time, they think I'm kind of crazy, but you gotta have a love-making relationship with money because because they gotta know that you're serious. They have to know that you're serious, and you have to have some form of understanding and nourishment and trying to get to know what it can do for you and what you can do for it, and all that good thing, right? So those things play a role in having your relationship with money, okay? Because guess what? We are in a time where money rules the zip code. We are in a time where money rules how your children go to college. All of that is really, really important for us to get to understand, right? So I wanted to make sure we talked about that because it's nothing to really be, think lightly of, to think lightly. You got to definitely know what's going on. So I want to look at this for you. Have you guys ever heard of germination? Germination is where the seed becomes the harvest. Have you guys ever seen that before? And if you ever seen that before, if you ever had a plant, or maybe you've grown a tree, or maybe you've had some fruits or some herbs that you've grown, right? If you've ever had any of that, then you know what germination is, okay? Germination is really about you seeing exactly how things grow, okay? And I want to show you this because it's one of the things that's really important. People don't understand that your money, the way it grows, is according to what you allow it to do for you. Okay? So let's look at this real quick. And I'm going to pull this up. And I want you to look at one key item here that I think is just phenomenal. It is called germination. Do you guys see this germination here? Now, I looked at it in a few different ways, and I couldn't decide on which one I wanted to show you. I looked at 12,000 versions, but I couldn't decide on which one I wanted to show you. If you get an idea of germination, germination is sort of like when you have a seed that you put into the ground, and all you've done is put it into great soil. And with that soil, you are watering it, you're nourishing it, and it is growing. It is in the right nutrition. It has all the good vitamins in the soil that it needs, right? That's exactly what you're doing when you put your seed or put your money into an account. So when you're putting your money into an account, like we just went through and we just talked about, and the interest rates and the returns, you are doing a germination process of your seed. And how do you make it grow? And so when you're trying to make sure your money is growing, you have all these different things that you can do with that money, right? But if you put it somewhere that it can actually have the right soil, the right seed, the right nourishment, the right watering, the right sunlight, it will give you a return that you can use later compounded. Okay? And I want to share that with you because as simple as it may sound, it does make a lot of sense. This is one of the things that I learned in economics many, many years ago as far as how germination works. Okay? So let's talk about this currency. And the currency that you and I are both aware of is what? American dollar. American dollar. That's what we're used to, right? The American dollar. But what about other currencies? I know there's several people here that have traveled. I want to show you some things. And I normally wouldn't do this, but I'm going to do it today. I pulled up some of my own currencies, right? And I know everyone is familiar with the American dollar. But let's look at other currencies. What you're looking at right here is a dirham from Dubai, right? Can y'all see that currency pretty good, right? Let's talk about the Vietnam dong. Are you guys familiar with the Vietnam dong? No? We're going to look at several different currencies here. This is Kuwait currency, right? And the point of showing you this currency is because no matter what country you're in, this is Zimbabwe dollars, no matter what country that you're in, we all have to learn how to master that dollar, how to master that currency, so we'll be able to use it to our advantage later. This is the Chinese yuan. Now I'm showing you guys my own personal currency, okay? But the reason why I'm showing you this is because, and I'm putting them back into their sheets. This is just how I carry my currencies. Put them back in their sheets now. But the reason why I'm showing you this is because no matter where you're joining us from today, no matter where you're calling from today, no matter where you're looking at this from today, we all have particular currencies that we use on a day-to-day basis that determine where we're going to be later on in life when it comes to retirement, right? This is what we call the Indonesian rupiah. This is also another currency, okay? And they all look very interesting, different colors, I know, right? But the reason why I wanted to show you these currencies is because the dollar is not the only thing that's making money out there, okay? You have a variety of different currencies that all have different values, and they may trade completely different against the dollar, correct? All right? But no matter where you are in the country, the one thing that we have to grasp is that we need to master our currency and being able to make it work for us, correct? So I wanted to show you those examples because you're not the only one that is trying to get control of their money. And part of that is changing the mindset that you can't be in control. Yes, you can be in control of your currency by making small changes, like number one, doing some investigation on who is holding your money. That's number one. And then number two, now you know who's holding your money. Are they going to give you something for them holding your money? It's not free for all, okay? So now that we have those two things accomplished and we know where to begin to make sure whoever is holding our money is paying us to hold our money, what do you do about future items? We just compared some currencies. We compared some interest rates, right? We looked at the calculator. Now, tell me where your thoughts are on your risk tolerance. Now, the reason why we're looking at risk tolerance, and it's not just 401k, it can be for your annuities, your IRAs, or whatever vehicle that you have working for you. This is just an example, right? Where is your risk tolerance? Now, right now, the stock market is going through some major things, right? Some major things. I've had several calls, and because I deal in 401ks, and I receive a lot of people saying, hey, Dee, I've lost 10,000, 8,000, 20,000 in the stock market since this whole thing began. What do I do, right? Well, there's a number of things that we can do, but it's based off of your particular circumstances, and we have to address them on a one-to-one basis. But the first thing that you need to realize is, what is your risk tolerance? Are you willing to get into the stock market here and be able to take all that possible risk? Everything that you see here on this left side, can you see that left side right there with my cursor? With everything you see on that left side with variable annuities, mutual funds, stocks, those have the highest possible risk that you can get, right? But what you must understand, with more risk is also the same opportunity for higher returns later, okay? And that's why they said they're more risky. But if you are a person that knows, hey, I want to retire in the next 5-10 years, I don't want to take on no more risk, I want to protect my principal, hello, then if that's the case, we need to move to the right side of this lever. And we need to look at more things like fixed products, index products, and making sure that your cash flows, and use annuities to protect your principal balance, right? So I want to make sure we talk about this today, because most of the calls and the text messages and the emails that I've been getting lately is really geared in this area. Now we're just going to touch on it today. We can spend all day on this one chart right here. We can spend all day on this one chart and go by bit by bit by bit by bit. But because of the sake of time, I want to make sure that we touched on the areas that would probably be more important to you. If you are a person that needs to protect their income flows, trying to guarantee income streams, trying to make sure that your 401k rollovers that you may have had or have not used yet needs to protect against a downward market, you need to be on the right side of this. I see you raising your hand. I see you. Yes, you need to be on the right side of this lever, okay? If you're a person that is higher in risk tolerance, they say, hey, I'm okay with the risk. I realize that I may lose some money now, but I can gain some real big returns later, and I'm willing to take that chance, and I'm willing to wait whatever time frame it takes for the market to turn over, then we need to focus you on the left side of this. And that's something that we need to talk about in detail. And as the Wealth Wednesdays continue to grow over the course of this year, we're going to have some special guests coming in talking about these type of things, the risk tolerance, talking about what you need to do to save those mutual funds. What do you need to do to get that 401k that is sitting there and you don't know what to do with it, but it's losing money? How can we go ahead and protect that balance right now? All of that is going to be part of what we talk about. Now, I'm going to dig into something a little bit deeper here, and I'm not going to stay on it long because I know that it can be a little complicated and we got to grow into this, but it's a part here that I really want everyone to see. And this is the investor credit and the market. So let's look at where we are today. This is 2020. Can you guys see this? Can you see that? We're in 2020. And this particular chart is talking about what is going on in the market right now. Okay. And this is not just because, you know, the Trump and then the coronavirus and the pandemic. It's not just that and that alone. Okay. It is a variety of different things that is happening in this market. So let me explain to you what you're looking at. On this side here, where you see the red, that is the negative part of the market. It's sort of inverted. Normally you see negative at the bottom and positive at the top, right? This one is inverted, just so you'll be aware. So the red here is indicating that there is the negative part of the market. And the green part is when people are saying, hey, I'm scared of the market. I need to operate only in cash. So you see here at this area here below that 0% there, that $0, that means people are operating in cash. Now, this red part that you see, these red inclines here from the dates of 1995 to possibly 2000, and then it starts again in 2005 to about 2008, and then it starts again here in 2009 to 2020. What does that red mean? What that means is that was a time frame where people felt like they could borrow more money from the broker dealers to put into investments. So that's what you're seeing right now. You see a lot of people buying up stock. They are buying up cryptocurrencies. They are buying up whatever they can buy up at a much lower rate. That's what you're seeing here in this red. It's the buy-ups. It's the buy-ups. Now, whenever the economy is doing well, people are like, hey, I don't need to borrow much money, right? I don't need to borrow that much money. But at this point, you see a lot of people that are borrowing against the market, and this is what you're seeing right here. And that typically means the broker dealers are able to do investments for investment bankers and things of that nature based off of them buying into the market, okay? If you think back to 2008, 2009, when we had the subprime lending issue, right here, do you see that? What happened at that time frame is typically what you're seeing is getting ready to happen now. They haven't put it on the 2020 charts as of yet. This is as of February 27th, I believe. It's the last day of this chart. So when they continue on this next quarter, you'll see that change there. But what you're looking at right here is that 2001 time frame, subprime lending. That's when they said, okay, the banks had too much fun. They gave out too many mortgages. They did all this subprime lending. Everything went completely bad. Now we're getting ready to go through inflation and recession. And so what you're seeing right there is this green mark right here, 2009. That's when people said, okay, enough is enough. I'm putting my money into cash and I'm not fooling with the market no more. So right here you see what it says, bonds, U.S. Treasury bonds and things like that. That's where those things are being purchased because people were afraid of the market at that point because of the turnover. Does that make sense? Now, we're not going to go too much in detail on that, but I wanted to just touch on that so you get an idea of what you're seeing right now. So when you see the market says, hey, we're doing well, we're turning over, we had an up day today, we had a down day today. That's great. You had up. This is what you're seeing in the up, down, up, down, up, down. But we're still in a position where we need to recover economic-wise, okay? On the S&P 500 returns, make this real simple. This red line that you see here is an indication of the market strategy. That's where you have no protections. That's the mutual funds, there's the stocks, there's for the ETFs or anything else that's out there that you trade that you don't have any protections. That's that red line you see right there. That blue line that you see in the middle, right above that red line, is what we call fixed interest. And that fixed interest is a fixed index market. That's your fixed annuities. Those are the things that you're putting your 401ks in with a fixed rate of 5 return, 6% return, whatever that return is. And regardless of what the market is doing, it is not dipping the way the red line is. You see that? Regardless of what the market is doing, it's going to protect you with that floor. That's that fixed strategy there. That green strategy there is the index market. And the index market is the next thing above the fixed, because what happens is that you are reaping the upside of the market. Every time the market goes up, it goes up. But when the market goes down, it locks at 0%. How does this help you? Not only do you understand now that your savings can make a return for you, but the other investments that you are working on, that you're working really hard for right now, pulling out of your paycheck, going into your payroll, going into your savings in your 401k and all these other retirement plans that you have, you can create a strategy within your own 401k to protect against this downward market. Even while your 401k is alive and you're currently working at your current employer, before you roll it over, you have the opportunity in your allocations to protect yourself through this downward market. Does that make sense? So I wanted to show you that is because even though they have fixed allocations, and if you have a 401k right now, what happens is they give you allocations that you can choose from. They say, hey, you can do an aggressive one, you can do a conservative one, you can do a fixed one. They give you all these different options of how you can allocate that money, right? But if you're not familiar with what's going on right now in the market, you can make a decision on whether you want to be conservative or if you want to be fixed, or if you want to take a chance and be a little bit more aggressive in your 401k allocations. Does that make sense? So we're just touching on this. We're not going to dive too deep into it because we can answer a whole lot of questions on these two charts right here alone. These two charts alone can be really in depth on what's going on right now with your money and your retirement, and we can go a little further into it. But I wanted to make sure that we at least touched on a few things that would help in the future. How do you do complete 401k rollovers from your previous employer? You can do a direct rollover. You can do a trustee to trustee transfer rollover, or you can do a 60-day rollover. It just really depends on the status of your position with leaving a job, being current in a job, or if you have anything else already set up within that employer that allows you to roll over before you leave the job. It really depends on those 3 factors. If you don't know, you're not sure, we can work with you. Just let me know. I'll be happy to answer that question for you. How do you know what's best for you? Number 1, you got to understand that no 2 households are alike. What's good for me is not good for Ms. Hartley. What's good for Mr. Thomas is not good for Ms. Stuttermeyer. So because of that, you have to make sure you let them answer the right questions. Ask them about the suitability analysis. Ask them to look at your portfolio. Ask them to look at some of your income streams, and then figure out what is the best route for you in this current economy. So I'm going to open up the floor. We've had a lot of information this hour. A lot of information this hour, and I know that we briefed on a lot of things, and I got a few questions that were texted to me. You guys should have went ahead and put those information on here inside the chat room so everybody else can see your questions. But one of the questions I have here on the phone from someone here on live listening in, they're actually listening in, they're not on the phone. They wanted to know, Miss D, I actually have a 401k with my previous employer, and they've been giving me a hard time on moving it. How can I make sure it moved to the right type of product? That would be a question that you and I need to get together on. We would need to look at your documentation. If you will pull your last statement for that company and let me dissect exactly the way it's set up, see if it is a traditional item or if it's a Roth item. And based off of how it's set up, we can maneuver it and roll it into the exact same qualifying or non-qualifying category. It just really depends on how it's set up, but we'll make sure that it meets all IRS stipulations. Okay? So let's open up the floor for some questions and some comments. I know we've had a lot that we went over today, and we want to just make sure we touched on the 3 major points for our launching of the Wealth Wednesdays that included currencies and money relationships, choosing the right savings for yourself, and then also the 401k rollovers. That was really important that we touched on all 3 of those. And so I want to make sure that we answered everyone's questions that they had. Do we have any additional questions that we need to go over today, or any comments? Will be great. Any comments that you may have. And I'm going to unmute everyone. Go ahead.
Jean, remember you had the picture up just a second ago with the 401ks and fixed annuities and whatnot.
That one?
Yeah, that one.
Mm-hmm.
What's the difference between the fixed annuity and the indexed annuity?
That's a really good question. So the fixed annuity is the main category, right? The indexed annuity is an item that falls underneath the fixed annuity, okay? So the fixed annuity is more so where it is a locked rate, where it does not change. It is locked into whatever time frame that you have that particular product for. However, on an index, it is actually considered one of the type of fixed annuities. However, it gives you the opportunity to have a more growth in an indexed annuity versus a fixed. Because on the fixed, let's just say that you have a 4% or 5% fixed annuity. That means it's 5% flat, regardless of what the market is doing. Right? But if you get into an indexed annuity, what it will allow you to do is not only take advantage of what the market is at that time, but if the market tends to go below 0%, it locks it at that 0% floor to protect your principal and anything that you may have grown. So it gives you the option of either just standing still or still having some movement in an index and not reap the bad side of the market by protecting your principal balance.
And see, when you have like our 401ks at work, like whether it's John Hancock or one of the other companies, they don't do a good job in explaining, okay, which one of these funds is fixed, index. They just kind of tell you, okay, this is conservative, If they ask you what year you want to retire, and then they pick the fund associated with the year that you're going to retire. So you don't know if it's fixed, if it's index, stocks. They'll tell you. Sometimes they'll say, well, these are mutual funds. Some of these are stocks. But they don't really, I don't think they really necessarily offer you fixed annuity and index annuity through those 401ks at work.
Right. And what happens is, well, they may not list it as an annuity. What they may say is that you have these particular categories that's in conservative. You have 3 or 4 choices that may fall in moderate. You may have 3 or 4 choices that may fall in aggressive. And the reason why they do that is because they have people, or they have teams of people that choose and pick what they want to be in that particular fund. So they may put, let's just say the fund is 20% small caps. It may be another 20-30% of large caps. It may be 5% of fixed rate. It may be a variety of stuff put into that Campbell soup for that one sum, right? But what they do is based off of your risk tolerance. They say, well, this person says that they have low risk, then we're going to put them in a conservative fund. The conservative fund may be more so geared towards bonds and more so towards cash items versus things like the small S&P 500 or small caps or large caps. So, because the more aggressive you are, the more they're going to put into the small and large cap funds. The less aggressive you are, the more you see those particular allocations that are saying something like bonds or ETFs, or they'll say something like that to give you a little bit more conservative growth, but not a whole lot of growth, right?
Or sometimes it lets you break it up. They'll say, okay, 20% will be aggressive, and the other 80 will be conservative.
Exactly. So when you're dealing with that, then it gives you that opportunity to say, okay, in some cases, some companies are really good and let you pick which ones you want on your own. Sometimes they do that. Versus you having to actually pick one of their pre-filled funds that they've already came up with.
That's what we have to do. Pick one of their pre-filled funds the year, and you say, okay, I want 100% conservative, or I want 20% aggressive and 80% conservative. When the market did what it did in the last couple of months, I just went 100% conservative. After I lost a couple thousand, though. Lost a couple thousand. And then I just moved it into 100% conservative until the system levels out some more. And then
and that's one way of doing it. You know, when you get in contact with like your 401k, whoever the HR person is or whoever their investment company is, sometimes they have an investment company built in, like a Vanguard or Fidelity. If they have something already built in, they're going to tell you to talk to the team, because they're the ones who's licensed to tell you what's the best role for you, things like that. But you still have to sort of make that decision on your tolerance, even though they may say, oh, the market's going to turn back around in such and such amount of time, or we're hoping that it turns back around within a certain amount of time. They really can't guarantee it, but they can say, hey, we're hoping and we things are going to change at some point. You know, historical numbers show that, you know, we've been through this before 20, 30, 40 years ago, and it turns back around. And some of that may very well be true, but we're also in a position right now with this pandemic and with everything else that's going on that we have never seen before in our lifetime.
Yes.
Not in our lifetime. Because, you know, like 100 years ago, they went through this.
It was.
Yeah. So they had the Great Depression, and they had this, and they had but in our lifetime, we haven't seen anything quite like this, right? So you sort of have to make that decision for yourself on your risk tolerance in your household to say, okay, well, I have a certain amount of money that's already saved. I have something else that may be very conservative that I can use as my backup plan, right? And then if you don't have anything else in place and your 401k is the only thing that you have, and you've worked so many years over, then your tolerance level may not be as high as the person that had a pension plan, or the person that have an inheritance, or the person that may have had money left to them through a will or through a beneficiary policy, because they have much more assets and they have much more things to fall back on than you do. Does that make sense? So that's where another thing where risk tolerance come into play, And then the person that is working with you, that's doing that suitability analysis, to look at your entire portfolio, your entire canvas, that person can say, you're a little bit heavy on this side. You're heavy on risk. You need to put some other safeguards in place, or you don't have enough risk because you want to retire in 20 years, where you need to put a little bit more money away, at this point. You need to be a little bit more aggressive, So it depends on the person's circumstances. And then go from there, look at their entire portfolio and say, oh, good here, you look really good there. We need to do a couple tweaks here and there based off of the goals that you have set. Right. So your goal is to pay for your kids' college. Your goal is to retire in 20 years. Your goal is to buy you a vacation home in Barbados. whatever the goal is that you have, they have to set your whole situation based off the goals at hand. And if you find someone that does not go that extra mile to look at all those goals and to dissect your ins and outs and assets and liabilities and define benefits and inheritance and sales of the business, if they don't go through all that with you, they're not the right person. Because that means they're looking at things, halfway, and they're not looking at a complete picture of what your needs are. Okay? That was a great question, Charmaine. Thanks for asking that question.
You're welcome.
Is there anybody else out there that had any questions? You can feel free to unmute yourself.
I have a question. This is Tamara again.
Yes, ma'am.
Hope I didn't miss it, but when you were talking about the stocks and bonds and all that, is there a certain amount that you have to invest, or can you invest, I guess, your own amount, or do they require you to have a certain amount if you're trying to do stocks and bonds and all that stuff? I'm not too
No, it's not a particular amount. Are you talking about doing it like through your employer, or you're talking about doing it yourself independently, like on an investment site or something like that? What's your thought?
I guess independently. I'm not too familiar of how to, do stocks, bonds, and all that stuff. So I guess independently, or through an employer, either one, would you have to have a certain amount in order to get started?
Gotcha. So the first thing I'll do is, if you've never dibbled and dabbled in stocks before, because that is a very high risk area,
right, I
would tell you to make sure that you're talking to maybe a CFP or an accountant to go over that with you to make sure that it's going to be a right fit for your finances. There's not a particular amount that you need to get started. Each stock has like a per share price, that kind of thing. Like if you want to buy a variety of different things, maybe some places that you shop at and you love that company, you may want to go out there and see how much their stock is per share, that kind of thing. Okay. But, or for instance, if you want to do a social media site that you love to be on and you want to go see what their price is per share, that kind of thing. So you have the option of like using some private stocks that you can do, like companies like Ameritrade and E-Trade and ScotTrade, all those companies out there, they offer those type of things for just buying stocks and everything. But if you are like trying to get it through your employer, you have more of a diversification option to do it that way, because you can get some things that are more so like conservative or moderate conservative or even aggressive, but it'd be more diversified versus you trying to be just buy one or two stocks yourself on the stock market without having any idea of what type of value they have, or if the company is balanced, if they're volatile, all of that, coming to buying stocks, that's a little bit more risk. Okay. Right. So when you're dealing with stocks itself, I would tell you to make sure that talk to an accountant or possibly a CFP on which particular stocks individually you should try if you want to do it that way. But me personally, I would tell you that if you want to start off just by getting started, look and see if your employer has a 401k that you can get involved with, which has a conservative option, or have an option that you can diversify more, okay? You can even create a fixed allocation within your 401k. So say, for instance, that you find some type of what they call it, like a target bond, or you find some type of some way of doing it in your 401k, then you can choose a fixed allocation if you want to be really conservative, but you want to make sure that some money is going inside that bucket. Does that make sense?
Yes,
and not take too much volatility of the market.
Okay.
Right? So it just really depends on, I don't know your risk tolerance. We haven't had a chance to talk outside of this platform. But, you know, if you're needing someone to work with on figuring out your risk tolerance, and then I can also refer you to other CFPs that does that higher risk. I am more so on the lower risk of the house. I specialize in risk management. Okay. So because I specialize in risk management, I am more so on the right side of this beam when it comes to fixed annuities, index annuities, being able to help you get, you know, 10, 17, sometimes 20% returns on the fixed side of the house and the index side of the house. But I specialize into protecting you from a downward market. That's where my specialty lies. If you're looking more so on maybe possibly taking some more risk on the stock market side, that's where I'll actually get you probably a CFP that's willing to do that.
Okay.
All right. Do you have any other questions? Oh, that was some good questions, guys. Really good questions. Did we answer everyone on the information that you had? Miss Chris, did you have a question? Did you send me a question? I thought that was you who sent me that question. No, that wasn't you. I was going to mess with you. Well, I'm glad that we had the opportunity to meet guys on this very first Wealth Wednesday. We did touch on quite a bit in the areas of interest savings. Don't forget, I'm giving you guys homework. I want you to Google high interest yield savings accounts. Yes, I want you to make sure you go ahead and Google that. High interest yield savings accounts. High interest yield savings accounts. And you can do the top 10 for 2020. All right. Very important that you do that, because I want you to start looking at things that you can use for yourself and making sure the bank is paying you to hold your money. Okay? It's very important. And number 2, I want you guys to make sure that we keep in mind that we have to also control our spending. We're going to look at that in our next segment on controlling the spending habits, how to adjust it. Really important, especially in this particular economy that we're dealing with right now, okay? So we're going to talk about that. And then in the weeks to come, we're going to have a special guest that's going to be coming in talking about interest cancellation, how to cancel the interest on large things like your student loans and your mortgage and all these other things that you can pay off much quicker than you have been paying off. We have some clients that are paying off their mortgage in 7 to 8 years versus 30 years. I mean, it's just by using the interest cancellation feature. So we're going to have that in the weeks to come. I want to make sure that you guys are actually here with that. We have a best-selling author with Amazon that's going to be here teaching on that, and he is phenomenal. I work with him in several different things, and also we have a lot of the same clients, so we work together hand in hand on quite a few things. So I want to make sure you guys get the opportunity to listen in on how to do those things and still keep your budget where you are right now. So there is a way to cancel the interest on your mortgage and still you live the same lifestyle that you're currently doing. It's a strategic way of doing it. But we're going to also touch on that as well. So I want to make sure that we've had any other questions. I see a hand go up. I think I saw a hand go up. Okay, I think that we're good. So we're going to go ahead and end this call. It's been a full hour, and I'm so excited that we're going to work with you. The next time that we're going to do this is 6 p.m. Wednesday, the 24th. Put it on your calendar. I will make sure that I send you an invite to go ahead and reserve your seat. And you will have that in your inbox this week as well. And so I'm so excited that we're working together, and we're going to answer as many questions as we possibly can. And we're going to have all these special guest speakers come in and teach on some additional financial things in the weeks to come. So with that being said, we're going to close out this call, guys. And thank you so much for being here today. Y'all have a great day. Talk to you soon.
You too. Bye.
All right. Okay, bye-bye.